what if we want cash flow versus money in 5 years? So cash flow versus money, I mean, cash flow, like when you say money, what do you mean money? I mean, cash flow is money, but like cash flow, you can get cash flow from owning a facility or lending money. I mean, I talk to investors on a daily basis, and there are investors out there that do nothing but just like lend their money out. And all they care about is cash flow. I mean, they're asking me, what is the distribution? How much am I going to make on a monthly or quarterly basis or annual basis? What is that distribution going to look like? Because I live off of this distribution. So I need to know how much money you're going to be making, right? Versus I own this facility and I'm running my numbers and I need to know what my cash flow for this property is going to be. So cash flow is just cash flow. It doesn't matter if you're lending the money out or if you're, you're owning a facility. Now I'm going to tell you, owning the facility is going to be way more work than just lending your money out. All right, just so you know. So when you calculate cash flow in owning a facility, make sure that you calculate your time and effort in working on this facility versus like wiring money over, running numbers, wiring money over, and then getting distributions. This is going to be way less time consuming than this is, okay? I heard vacancies are rising as the recession kicks in. What occupancy rate should I model for? We run our numbers at 92% right now, 92%, okay? We talk to so many owners. I'm full. And then they want us to run their numbers at like 98% or 99%. But the truth is like 90% is like, I think, a good number to run your numbers at. But the truth is like, especially in primary markets, I would say in a primary market, run your numbers at 80%. In a secondary market, maybe 85 to 90%, and a tertiary market, like 90 to 92% or something like 88 to 92%. Is going to be like a good number. Like, so you never want to run your numbers at 99%. So 90%, I think, is a good solid number for tertiary markets and, secondary markets. And now physical occupancy is different from economic occupancy, right? So physical occupancy, is like, I'm full, right? I'm like full. Yeah. Okay, great. Well, is everybody paying? So we're trying to buy this facility right now where the guy is, he's full and he should be making 150 grand a year, but the truth is he's making like 110 or something like this. So that means his economic occupancy, those that are actually paying, are low. That's the difference between physical and economic occupancy. Right. So make sure that you understand those two as well, too. And you're looking at that. Now, obviously, like, if you buy a facility that's at like 75% economic occupancy, and, I'm still running my numbers at like 90% physical occupancy. Because, the ultimate goal is to get this full. As is, you could maybe run it at like that current, we run it at that vacancy, right? So it's, it could be at 65% full or 75% full. But the truth is your goal is to get it to 90% full. And a lot of people are saying, okay, like I'm getting more vacancies and stuff like this. But the truth is that like, that just probably means their prices are too high. Right. And you want to consider that when you're running your numbers and looking at competition. Like, you do not want to run your numbers, your price per square foot, at like the highest, the number. And I've talked to several banks where they said, like, we ran our numbers at like 90% full at like, 90 cents a square foot. And like now they're 85% full at 80 cents a square foot, and they're barely able to make the mortgage. Right. So you want to keep that in mind, You don't want to be like, oh, the competition around the corner, the big one over there is charging double, so I get to charge double. You want to look at the entire competition and what they're charging, and then over the course, of like 3 months, what have they raised their rates to, and are their rates dropping? And you can see this in Radius Plus. Okay. So for instance, we bought a facility in August where the entire area, the price per square foot within like 10 facilities within like a 10-mile radius is like $1 a square foot. And so we ran our numbers at like 95 cents a square foot is what we did. Like we just wanted to be ultimate, like ultra conservative and say, okay, like we're not going to get to $1 a square foot. We're going to be like a little bit less than that. So you just want to be like super conservative, especially right now. Now, obviously it's a cycle, right? So they may not be full now, but eventually they'll get full. Although everybody that was full this past year or so will not be full, may not be full over the course of the next year. So it's just a cycle, but you want to make sure you just get that average, right? A good solid number. Say like, I feel comfortable with this number. Like I know that I'm not pushing this number. I'm not going to push myself, that's the goal.